Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 26th of 2026. A lot to discuss this week. We'll start off with a discussion of inflation and inflationary impacts here. We have basically looking over the last 5 years, we've got several categories to acknowledge. Some of these are going to be fairly intuitive. If you go and do any grocery shopping, you know that coffee has gone up over 100% in the last 5 years. And certainly we know over the last couple of years with the thinning of the herds that beef prices have gone up. So you can see 66%. And then other, you've got eggs and you have, groceries as a whole down here. And then you have other components, energy related. Obviously, we've got gasoline that we know is tied to oil. That can be pretty volatile, but we've got home prices, and certainly we've acknowledged that coming out of the inflationary boom 2022 when home prices went up quite a bit with inflation. And then utilities, transportation, and auto insurance has also gone up quite a bit. And so, very clearly you begin to see the picture here of why we have this K-shaped economy that you talk about, like your grocery bill, and that's going to impact your lower income cohorts a lot more than your upper income cohorts. And you can see, why the sentiment is so low, and we've got charts on that. We have charts on the K-shaped economy coming up. But again, just looking at this over the last 5 years, and you think about the average rate of inflation over that period, and even if you take some of these categories and divide them by 5, you can see very clearly some very, very important categories of spending in our lives are tracking much higher than the overall rate of inflation, and this has put a lot of pressure on sentiment. Here we have another depiction of price changes and inflation over time. This actually goes back 25 years. We look at the overall rate of inflation here. This is an aggregate level, so not an average annual or annualized number. This is the aggregate level of inflation that we've seen in over the last 25 years, so about 93%. You can see some of these categories have tracked much higher than that. You see hospital and healthcare related categories have gone up quite a bit. Obviously, education has gone up, child care, and you see how housing here and food and beverage, we just got through talking about, particularly over the last 5 years. And then here is we've been talking about wages for a long time. And so, there was a while where we did have flat to negative real wage growth. That just meant that wages were not tracking to inflation. Well, they certainly are exceeding it now, and you can see at least over the last 25 years that we've had real wage growth. Now, we have had inflation in some other important categories like automobiles and household furnishings and so on and so forth, but they've been below the overall rate of inflation, and that's why these categories are in blue. Everything above zero represents positive inflation, and even clothing, we've had slight inflation. This is actually very minimal, but household furnishings, et cetera. And then in some of the areas where we've had innovation, productivity from technological improvements, TVs you see have gone down quite a bit. And certainly if you've been to your local Costco and looked at the 70-inch TVs out there, you can see that, they're basically the same. They're at a price that you could have bought like essentially a 20-inch monitor, 10, 15 years ago. Interesting chart here. We've got hedge funds. You talk about, who is going to step in and fill the void now that we've seen a fair amount of disintermediation at the central bank level from owning treasuries. We see a lot of central banks that are shifting the maintenance of their reserves from treasuries to gold. And so correspondingly, we've seen a huge spike in gold prices. But with central banks replacing those assets with gold, that means that, and certainly the fact is that our deficits are going to continue. So we're going to have net new issuance of treasuries, and that's going to continue to grow, but we need to find buyers for those. And I found this to be pretty interesting. You look back, going back to 21, 22, when the genesis of this latest bump started, hedge funds only owned about 3% of treasuries, and now they're up closer to 8. And so they have effectively filled some of that void that's been created by these central banks. And it will be interesting to see, to the extent that hedge funds continue to hold treasuries, how that could help to support the overall treasury and, as a result, the corresponding bond markets from there. We have a chart from BlackRock, and this actually goes back. My intrigue on this data goes back to a conversation that I listened to. The CFA Society here in Austin hosted the former Dallas Fed chair, and he was talking about really the net inflationary impact in the early years of the AI buildout. And that's just because you have related spending that has to get you ready for that. And some of that is human capital to design what your prompts are going to be, and processes and things like that. Some of it's hardware, and so he maintained that it's going to be a net inflationary impact, which is a little counterintuitive. And this chart really supports that theory, because you can see here in the first 5 to 6 years, BlackRock here is showing a net inflationary impact of capital spending, that has some disinflationary components, but that disinflationary impact in overall inflation doesn't really kick in until the latter half of the next decade. And I think that's something that, amidst all the capital spending, dialogue that's going on out there, and all of these expectations that are being built into earnings, I think it's important to realize that this could be a net inflationary impact here in the early years. Talking about AI and continuing that conversation, it's important to also note that technology has taken on a bigger role within the credit markets. And you can see just in investment grade here, we've got high yield, and we have leveraged loans. And if you look at 2006 and kind of fast forward, really in each of these categories over the past 20 years, and we can see what a much bigger role that technology and to a large extent AI is taking in these markets. And so, there's been a lot of conversation about private credit this spring, about these non-bank markets that are witnessing stress because you've got technology related credit out there that could be adversely impacted by AI. And of course, there's really a lot more rhetoric than there is substance right now, because we haven't seen a huge dislocation in credit quality. But nevertheless, looking at these numbers, it kind of explains why you have some concerns out there in the credit markets right now. I have a chart on business applications. I think I showed you one of these, or showed you this chart several months ago. And it continues the trend that we identified back then, in the fact that we've had net new business applications or business formations. And the argument is that a lot of these are tied to AI. A lot of these are small companies, like 1 to 5 employees, or maybe 1 to 10 employees. Very positive development here. This is one of those things you look at amidst the backdrop of some potential slowing in the economy and things like that. And again, we are a highly entrepreneurial society, and I think that's very much in evidence here. We'll look at credit exposure from the Middle Eastern conflict, and obviously the headlines change by the day. And today, in particular, the negotiations in Pakistan were called off, and so we apparently will not be sending a delegation of negotiators there, but that could change tomorrow. But having said that, you've got areas of the market. You have a lot of areas that are impacted, and these are all very important areas, and some are less intuitive than others, like maybe hospitality. But certainly, you think about everything related to energy that could be subject to disruptions. You've got consumer products, automotive, chemicals, certainly, and you look at these categories here: building products, Certainly the airline industry with kerosene and jet fuel, that's already a problem. And then you get down into some of these other components. And so you can see that the impacts from the credit markets are fairly broad to the extent that this persists, this conflict persists for a while. Now, some comments on the consumer. We have a trend that we have identified for a little while now. We see a deceleration in the personal savings rate. While we've celebrated consumer spending growth, we do see that that's coming at the expense of a declining savings rate, and that also dovetails with the fact that we're seeing a deceleration in real after-tax income growth on a year-over-year basis. And so, again, the health of the consumer is very important to the economy. And I'll say right now, it's still positive. And I'll also say something else too, that even though these numbers may look low, like the current reading is like 1.25%, just bear in mind that this is real after-tax income. So this is net of the inflation impact. And so, when you talk about, nominal after-tax income, that number's, essentially 3 percentage points higher. Credit card debt average interest rates, showed you this as well some months ago. Very interesting development when we hit the high inflationary period post-pandemic. Those rates went sky high. And you can see this data goes back to 94. So, it's a pretty stark increase. And what the issue here is that it's just remained sticky. It just hasn't come down. And so this is even more pressure to the consumer, particularly those at the lower income cohorts that are using more credit card balances to fund their purchases. Here we have some data from JP Morgan. This represents on the left-hand side essentially net worth growth, and where does that come from? This is kind of like literally the drivers of consumer spending up here, and so you've got almost $50 trillion of net worth growth that's represented by the top 20% of income earners, and 17 trillion is accounted for by the bottom 80%. Of course, this is nothing to scoff at. This is in aggregate terms a lot of net worth, but you can see that the power of that top 20%. And then over here, we've got consumer share of total pre-tax income and spending, and you can see, if you take essentially, I'll just kind of make this a little bit easier to digest here, but you've got essentially the top third, call it, of both of income cohorts, account for, basically about 60% of all spending, and about 73, almost 75% of all pre-tax income. So I think obviously very important cohort. Not that these are unimportant, it's just that they have less influence when you look at consumer spending data, and that data has actually not been that bad. But again, these areas are not spending as much. They're certainly spending a lot more as a percent of their own income. But that's why we see some differences in the data where you see consumer spending remain relatively high and you see consumer sentiment be very, very low. That is depicted in this chart. This is the K-shaped economy. So you talk about what happened after the pandemic, and that's essentially this line here. Sentiment has continuously gone down. This is the University of Michigan consumer sentiment number. And then on the opposite side in the green here, we have Wall Street, and that continues to move higher. And of course, you have a disproportionate number of more wealthy folks that own stocks that are actually benefiting from this continued growth in the markets at the same time that you have a continued degradation in sentiment levels. And when you go back before the pandemic, these things were much more in lockstep, but we have more ownership of stocks now, and we have a greater concentration of ownership in the upper income cohorts. Something else I've been following too that I think is going to beg some potential regulation here, and I'm not sure how motivated our current administration is going to be to want to provide some of that regulatory overlay. But clearly, you've got prediction markets. A lot of conversation now is this: does this need to be regulated as gambling? And but it's taking off, and you can see here very clearly not only in terms of notional volume of transactions within the prediction markets, but also number of transactions and users are continuing to blossom here. And so, this is essentially, betting on things like what's the probability that, back, earlier this year, what was the probability that the U.S. military would take out Nicolas Maduro in Venezuela? And what's the probability that that we will have a ballistic engagement with Iran earlier this year as well? And that's what these prediction markets are. And you can just see here that there's a lot more activity, and I think it'd be very interesting to see if and how it gets regulated in the future. Now we look at tariffs. Quick update here. After the Supreme Court knocked down the IEEPA tariffs earlier this year, you can see here very clearly that not only did we have a drop in overall revenues because those tariffs were deemed unconstitutional, but we also had a corresponding drop in the tariff rate. But you can still see that those levels, whether you're talking about tariff rates or tariff revenues, are still very elevated relative to the beginning of the year. Okay, quick comment here on housing. Got a couple of housing related charts, and this is important. Why? Because housing represents a big part of core inflation, and you think about all the derivative spending that comes out of the residential and the real estate sector in general. You've got a lot of labor influence there. Obviously, you've got materials, you've got secondary spending, home improvement, a lot of things. And just looking at existing home sales, I mean, we're really in kind of the doldrums. And not every market is this bad, but basically, you see, March of this year, existing sales dropped to just under 4 million annualized, which is down 25% from pre-pandemic levels. And this is obviously a real soft spot in the economy right now. Now, having said that, you've got profit margins for home builders. Again, the prior slide really talked about existing home sales. This is for new builds. You saw that not too long ago, when home prices were moving higher, that builder margins were fairly robust at over 20%. They have dropped back down to about 11 to 12%, which is still a little bit higher than they were before the pandemic. But you can see here the incentive, well, I guess I'd talk about the influence of the housing sector on the overall labor market is something that should not be understated. And right now you're at this environment where profit margins are such that, that at least this particular sector of the economy, they're not firing people, but they're not hiring people either. So we're at a point of stasis. However, if these margins were to continue to drop, then I think you would see more of an adverse influence on labor coming out of the home building industry. So this is something that has really caught my eye, and you can see the divergence, has continued to take place, going back, call it almost really 50 years here. And this is the deviation between median home prices, which have continued to go up. And obviously, we know 2020, they, in the aftermath of the pandemic, they really accelerated out. You can see the line of best fit moving kind of like this. And you can see median household income continue to move like that. And so this gap is getting wider. And so this is making affordability much, much more difficult. Something else that caught my eye out of some data. This is data from D.R. Horton, big, large national home builder. And this shows the percentage of their mortgages that they're originating, and this is the percentage that are made to FHA or VA, Veterans Administration borrowers. And typically, particularly FHA, Federal Housing Authority, FHA loans are made to borrowers that don't have as good a credit. I'm not necessarily saying that that's VA, but just when you think about this as a group, that these are folks that don't have as good a credit overall. And you can see that, coming out of 2023, that number has really expanded. So again, the speculation is this going to impact credit quality? Is this apt to create a scenario where you have a rash of defaults? And it's too early to tell, but at least for D.R. Horton here, you can see that they've really made a large bet on that particular constituency group that are doing those types of mortgages. Here we have some import prices. Again, this is going back to our conversation on tariffs. Very clearly, you've seen some of the impacts there in terms of the 12-month percentage change and even the 1-month changes. I mean, this is something that certainly bears watching, even if the tariff rates have come down, as we just saw about a couple of minutes ago. But clearly, prices are moving higher. Now we have a quick look in on producer prices. We have the energy component of that, again, as we would expect with a Strait of Hormuz kind of situation out there in the markets. You've got core PPI here that's moving higher in the green, as well as year over year, just the headline number, both driven in some measure by tariffs. We have manufacturing jobs. I've always found this chart to be very compelling. Again, you got post-World War II. We had over a third of the economy that was employed in the manufacturing sector, and that just continues to fall. And this is a well-established trend, well-understood trend. We've become much more of a service-based economy, and so manufacturing is less impactful. But even at 10, 9, 12, whatever, the manufacturing economic data is still very important. I want to talk about, AI again. This is basically investment. So this is capital spending amongst the major hyperscalers, which are obviously the well-known names that we all know here. And you can see, looking at even 24 to 25, you can see a big jump in capital spending. And then all of these announced expenditures coming in the coming through 2 to 3 years. This is an amazing amount of money, and so there is now a seed of doubt: is like, can they honestly spend that much because of this cash flow? And so this is the equation for free cash flow. And so you've got operating cash flow that comes out of the business, and then you've got these capital expenditures or capex, which we see here is accelerating. So if you've got that accelerating, that's going to drop your free cash down here. And so the question is, is this sustainable? Is this doable? And again, if it pans out, it's going to be highly impactful in the investment markets down the road. More AI information. This is here you've got the AI driving data center construction. We know that from a non-residential construction standpoint that this has been a big deal for a number of years. And you've got office, which we know after the pandemic and the vacancy levels rising has fallen off a cliff. So you've seen a real changing of the guard here in terms of the composition of non-residential construction. And then on this side, we've got data center power demand. So this is something else from when you think about infrastructure investing and private infrastructure investing, which I've looked into quite a bit over the last couple of months and spent some time talking to people in Arizona about this at a conference. That this is clearly going to be a thing. That there's going to be a lot of money committed to the power gen problem that's created by all these data centers. Electricity demand, really just speaking to what I just mentioned here, we've got a big surge in that. This is essential, basically conventional data centers here. And then you've got the AI related data centers, which has different chipsets, different processing, and you can see that this within a very short time is going to require a tremendous amount of energy, and that's just not me speculating. This is coming directly from the International Energy Agency, the IEA. Here we have mergers and acquisition activity. And interestingly enough, deal volume has actually been picking up, but you can see a concentration here in the very large mega deals. The ones where you've got deal sizes above $10 billion. We've got bank lending that seems to be picking up here. This is very interesting because we saw kind of a tepid environment in terms of C&I loans, which are commercial and industrial loans. But certainly this year, we've actually seen a pickup in that. So credit, despite the fact that in many circles we feel like it's maybe not getting any looser, the data tells us that it is in this blue line here. This slide, we kind of shift gears here, talk about the US dollar. This is an interesting development that seems to have accelerated. This is basically, kind of talking about the hegemony of the US dollar. And this represents US dollars as a percent of global foreign exchange and gold reserve assets. And you can see that number has gone down quite a bit in a relatively short period of time, even though it's been in some decline ever since the beginning of this century. But maybe more accelerated because of trade disputes and overall trade. But we definitely see the U.S. dollar in disintermediation. Another interesting chart related to treasuries, and here we have essentially foreign treasury holdings. Now these are official, like central bank holdings, and you can see that these have kind of flatlined, like we've been talking about. U.S. dollar denominated assets have been in less demand by foreign central banks, and you can see how that's flatlined here. But an interesting development is that we've seen really in the last couple of years an eclipsing of the amount of treasury holdings by private holders, and we've already seen where like at least domestic hedge funds are owning a lot more treasuries, and you can see here clearly that private foreign purchasers now own more treasuries than do foreign central banks. I have kind of a relationship slide to share with you here. This kind of looks at low inflationary environments and high inflationary environments and their impact on certain parts of our certain asset classes here. And you got the S&P 500, and this should be fairly intuitive. So you tend to have lower overall rates of return when you have higher rates of inflation. In this case, with consumer price inflation above 3%. And same goes for high yield, and to a lesser extent in investment grade over here. And not too surprisingly, when you have easy credit, you have easy money, inflation below 3% or at 3%, that you're going to have overall higher returns in each of these categories. We talked about correlations between asset classes off and on over the course of the year, and you can see here that like basically since we got into that kind of hyperinflationary environment that we had to begin raising rates, and 22 was a difficult year, but at that point, and this is what we have consistently noticed, is that not only are bonds much more volatile on balance than they were prior to the pandemic, but we've also seen the correlations in returns between stocks and bonds become much more positive, and this is something that honestly that we just haven't seen in a very long time. I mean, the correlation here is like basically 0.6 to 0.7 And that's a fairly good, fairly tight relationship. When what this means is that when you have high correlation of returns between stocks and bonds, you're not getting the benefits of diversification. And so this is prompting us to think a lot differently about how we approach portfolio construction and some of the tools that we're utilizing. And again, it's making us think a little bit more about private markets that have lower correlated returns and other levers that help give us the diversification that we're not getting in the conventional kind of stock and bond indices. But just to be fair, looking at things in a little bit of a microcosm and just isolating 2026, we see perhaps a little bit of a different story here, and this may be sending us in the right direction. Where in the blue we've got the S&P 500 index here, and of course we sold off in the Iran conflict, and we've kind of battled back since. As a sense of complacency that this thing will be over soon has seemed to have set in. At the same time, we've got 10-year Treasury yields on the right-hand scale, and so those have been moving higher. And so you think about the inverse relationship on Treasury prices and yields. So when yields are moving higher, prices are going down. So you actually do have some diversification benefits right now, just in a microcosm, as you've got markets are moving higher and bond prices that are easing off a bit. So when we talk about diversification, when you start introducing, non-traditional asset classes, I think this is honestly a slide that could necessitate its own charts of the week just by itself. But when you think about, volatility, which is what we're trying to control, right? Equities have a pretty high vol. And on average, you've got like anywhere between, depending on what index you're looking at, it could be like 15 to 18% here. So, but you do get a higher annualized return. And, you talk a lot about private equity. Well, you get as high a return on average as equities, but you get basically a volatility level that's half of what equities are. And you think about fixed income down here, you have a very low volatility. In fact, it's basically 1/4 of the volatility as equities is more like, it'd be more like here. However, you're only getting about 2.5% on fixed income. So what can you do to help your overall risk adjusted return? And the idea is get involved with more private investments. Hedge funds we've talked a little bit about. Those have been around a long time, but they are uniquely different from one issue and issuer to the next. And then you got private real estate and credit, which we've already talked about. So I mean, you've seen a lot of money flow in here, and this is an area of the market that's been highly, I'll call it democratized, where you have products that have called interval funds, where you have the ability to buy, like you would any mutual fund. You're restricted every quarter to taking out maybe 5 or 7% of your total investment. But they do give you the benefits of investing in private equity and private credit. And you can see here too, we've already talked about private equity providing equity-like returns at half the volatility, and you've got private credit, which are probably, heretofore have been providing really good returns with basically half of the volatility of overall fixed income. And so, as we talk about the correlation in returns between fixed income and equities, it's going to be important to introduce these categories into the portfolio construction conversation. Another chart here really talks about the correlations to the kind of the conventional portfolio. And so this is like, where the world started many years ago. Stocks and bonds. Stocks are 60%, bonds are 40%. Basically the correlation to itself is 1. So, then you get basically call it this is showing a 10% annualized return, but I think the data is probably more like 6.5 to 7.5, somewhere in that range. But then, with the advent of the private markets and the commoditization or the democratization, I'll call it, as I mentioned in the last slide, where the average investor can get into these types of products. You can see that the correlations are important. So when you're trying to diversify away, the risk of equities and like we were talking about a couple slides ago, where equities and fixed income had higher correlations, you really want something that has less correlation. And so that's why you got real estate, you got transportation, infrastructure spending, overall infrastructure spending, venture capital, private equity, and private credit, all in these particular buckets that can help you get diversification because of lower overall correlations. One thing I have certainly noticed is with the advent and the democratization of private investments, that you see more financial professionals getting involved in it. And obviously, we are doing a lot of work internally. We do have some exposure in the private markets, and we're thinking about it a little bit differently. Again, this is another one of those slides that probably needs its own like podcast, if you will, but you can see here, high net worth individuals, and these are like the ultra high net worth. I mean, they have 10 to 20% of their assets in, I'll call it alternatives or private investments. The overall financial professional market is like 6. And then you get into kind of these more like esoteric and like uber sophisticated environments like Yale and Harvard. I mean, they're like at least half of their investments are in the private or alternative space, and you get into family offices, and they're at least a third, if not more, there. And so, the groundwork has certainly been laid for allocation into the private markets. It's just taking a little bit slower to come about in the conventional kind of like the mass affluent markets. But again, the products are there to be able to do that. But there's a lot of different products, and they're all different. So it does require a lot of research and a lot of work to be able to get from A to B. Have some slides related to long-term investing, and as those people that know me well know that I love these really long-term charts because there's no better way to kind of like dial out the noise, the near-term noise of market volatility. If you look at this line, and this is really, I mean, oddly kind of straight. Now, there are moments in time where the market movements definitely do not feel linear, but the market, when you talk about the market usually goes up or it goes up over time. Well, this goes back to 1870, so I can tell you that if you have the perseverance to wait out bumps along the road, and so I mean, you've got a lot of these things that we've read about in history books. You've got a lot of things that have happened in real time during our careers. Not that there hasn't been very visceral moments in investing, but if you have the perseverance, even in like, call it, 1920, 1930, and you're here and you go through the roaring 20s and have the Great Depression, but yet you were in your 20s and you had something. Again, a lot of people didn't invest back then, and the landscape totally different. But just say if you had a 30-year, 20, 30-year time horizon, then I mean, look where you are at that point. You're here, and so you've done quite well, despite the fact that you've had a lot of noise in between. And same goes for basically the post OPEC embargo environment where we had kind of a lost decade. We had Vietnam. We had another lost decade here in 2000s after the tech bubble bursting. But again, if you have a long-term horizon, then you plow right through these episodes. We have global stock and bond ratio. As to say, the way to read this is that you have much more of an emphasis on stocks over bonds, and typically, when you see this roll over, it's still moving up, but when you see it roll over is typically when you see recessionary environments. Now, you do have some false positives here on occasion, which make this not a completely accurate depictor, but I think it's it is interesting to look at this and say, listen, there's still a reasonably low probability of recession indicator as the market continues to move higher. Liquidity is a big topic, and honestly, you look at why is the equity market continuing to go up? We've got a war with Iran. Depending on what day, we may or may not have a truce, or somebody may not be bombing somebody else. But a big reason why the market continues to go up, and this is the x-axis here. This goes back to 2022, and is the fact that we've got a lot of liquidity. Now we lost global liquidity for a number of years, and then it began to come back, and that's provided a lot of the feedstock for the equity markets to go higher. Quick look at the Treasury curve. I think it's important to realize that we have had interest rate increases, and I'd say the real issue here is that interest rates have gone up all along the curve. So this kind of solid light blue line, basically represents the end of last year, and then we had basically here we are sitting in April. This is April 22nd, so just a couple days old, but you can see long rates have not moved as much, but they have moved higher. 10-year rates, we know, have certainly moved higher, as has some of the interior of the curve, the near-term curve. Now, if you look at forward rates, then they're looking even higher. You're getting about 5% on the 20-year and also on the 30-year. And again, this is an upward sloping yield curve. This is a normal curve. You don't want to see that invert. That's usually, has in the past been a recessionary signal. But again, a parallel shift up, which is what this really represents, is not an unhealthy development at all. Here we have a chart depicting the percentage of ownership of equities by the older age cohorts. I alluded to this earlier, but you can see that people that are older than 70, you see that share continues to move higher, and meanwhile we're kind of flatlining by the younger generation. What this tells me is you're going to have a lot of wealth transfer in the coming years. Here we have lifetime wealth creation. I think this is really interesting research. This is research that Tom Kimler on my staff kind of brought to our attention. I looked into it a little bit, and I thought, when you look back over, essentially 100 years, that basically you had about 3.7%, call it less than 4% of the stocks generated 100% of that wealth creation over that last century. And so, the argument here is that you should be diversified. If you're really trying to pick the winners, it's telling you that there's a majority of stocks out there that are not going to help you. In fact, if you say basically 3.7% generated 100% of the wealth creation. Here you've got basically 7/10 that created 75%. You've got 16 100s that created half of all wealth over the last century, and it goes down from there. So obviously the benefits have been generated by a relatively small handful of stocks, and again, I'd say this probably is impacted a bit by survivor bias. So you've got stocks that did really well that are not around anymore. So but it's really compelling research that and it speaks to the power of diversification. Busy chart here. So the takeaway is that we have had a number of greater than 5% corrections since 2009. And, again, we're kind of battling back from the doldrums. This has been a great chart to show you back in March when we were selling off. But this is something to remember over time that, 2009 to 2025, I mean, you can see some years we have multiple corrections of some measure, right? So not to belittle this, and you've got different reasons for that. And obviously I'm not going to read from this, but just to say that it's not abnormal to have corrections within a trending market. And so the fact that we've had quite a few of these, and we're still, not too far from all-time highs, is something that we should celebrate. And it really speaks to the power of that first chart that I showed you going back to the 1800s, that this market has a strong long-term upward bias regardless of near-term circumstances. Some interesting data here. We got forward returns. When you hit an all-time high, intuitively you think, all right, well, the next several years are not going to be that great. Well, in fact, that is not entirely correct. If you hit an all-time high, you're on average, this goes back to 1989, so your average return the following year is 13.6, the ensuing 3 years, 46%, and then over the ensuing 5 years, 82%. And that's actually ahead of if you invested at any other point in time, on average, your returns are good. So not to be scared from all-time high, levels of the index. That's not to say high valuations necessarily, but just don't be scared of the index at lofty levels necessarily if you're a long-term investor. So again, another chart that would have been really helpful, and I think we did include this in a March chart pack, or late February, early March. But when you hit bear market lows, again, this isn't very intuitive that you're going to have really good performance if you hit a low. Now the problem is knowing when you've hit the low, and that's very hard to determine. And generally, you only realize it, probably a month or two after you've already hit it. But in any case, suffice it to say, again, if you're not only diligent and consistent and stay, true to your investment policy, you're apt to do well. That's what that last chart showed you. This one shows you that if you're actually able to be opportunistic when valuations are low because you're at lows in your bear market, the returns can be very, very exceptional. This is a really powerful chart, and I've seen this presented in about 15 different ways. This is helpful in the sense that it's really 20 years worth of data. And, again, if you are in the market, fully invested the whole time, you're diligent, you're investing according to your investment policy, and you don't let emotion enter into it. I mean, that your average return over those 20 years is about 11%. And so had you, invested 10,000, you would wind up with about almost 81,000. And if you missed the best 10 days of the market, which 6 of the 10 of the actual best days in the market occurred within 2 weeks of the 10 worst days. And this is the problem, is that people get out when they get panicky and they let their emotions drive them and they don't get back in the market. And so they miss 6 of these 10 best days because they had bad days in the market and they got out and they didn't capture the upside. And you can see if you miss just 10 of the best days over 20 years, you've given up basically more than 50% of your return. And again, if you're sitting on your hands even longer, it gets worse and worse and worse to the point where, if you stayed out of the market for basically more than a month and you missed I shouldn't say that, if you missed the 40 best days, and that's, being rather selective, but, you could actually see yourself with a negative return where the average annual return for people that are consistently in the market and not selling are like a positive 11%. This has a lot to do with, I think some to do with like how poor returns are generated within 401ks. And, people get a little cute and they're changing their allocation all the time. They're completely reactionary to market forces. And, this is a slide that is very educational and it teaches you not to do that. Magic of compounding. I love this chart. And this is, these are charts from Creative Planning, which does such a great job of education here. So basically looking back 1976 to 2026, 50 years of data. And you can see here, the power of compounding, just even over 10 years of compounded returns starting in 1976, you would have had, almost 38,000. 20 years, that's 101,000. Again, you remember that long-term chart of the S&P 500. You've had peaks and valleys, but that's still that's a tenfold increase in your investment in a 20-year time frame. And then it just gets better and better. And again, if you have a 30-year investment horizon and you just put a lump sum 10,000 in, again, at least from March of 1976, you would have had turn that $10,000 into 265,000. And then similarly, if you have even longer term horizons, that gets to become a pretty impressive number. Well, that's all the charts that we have this week. I hope you have enjoyed it. Have a great week, and we'll talk to you again soon.